Hey everyone, welcome back to Corporate Decoder, the place where we make sense of all the corporate jargon and financial mumbo jumbo, a company that's been going through quite a bit of a roller coaster. Today we're diving deep into Ascend Wellness Holdings INSIN latest quarterly report for the period ending June 30, 2025. Now before we get into the nitty-gritty, the company itself is a big player in the US cannabis industry, cultivating, manufacturing and selling cannabis products through their own stores and to other retailers. They are in states like Illinois, Maryland, Massachusetts, Michigan, New Jersey, Ohio and Pennsylvania. One thing to note right off the bat is that cannabis is still illegal federally in the US, which creates a unique set of challenges and risks for the company and its operations. Let's jump right into the numbers. Looking at their balance sheet as of June 30, 2025, Ascend Wellness Holdings reported total assets of $903.8 million at the end of 2024. On the liabilities side, their total liabilities stand at a pretty hefty $87.7 million as of June 33.5 million as of June 30, 2025, up from $80.6 million at the end of last year. This increase in liabilities is mainly due to a significant jump in long-term debt, which rose from $234 on the liability stand. Their total liabilities stand at a praise in debt is definitely something to watch. What? On the liabilities side, their total liabilities stand at a pretty hefty $75.7 million as of June 30, 2025, up from $80.24 million. That increase in debt is definitely something to watch. Now let's talk about how much money they're actually making and spending. For the 3 months ended June 30, 2025, revenue net was $127.3 million. This is down from $441.5 million in the same period last year, a drop of about 10%. They attribute this to increased competition and pricing pressure in most of their markets. Their cost of goods sold also dropped, but not as much as revenue, so their gross profit remained pretty flat at around $41.5 million for both periods. However, their gross margin did improve slightly to 13.2% from 29.4%. When we look at their stockholders' equity, things have changed quite a bit. For the 6 months ended June 30, 2025, their total stockholders' equity is down to $28.1 million from $71.8 million at the end of 2024. This is largely because they reported a net loss of $43.6 million for the first 6 months of 2025, a significant increase from a net loss of $39.9 million in the same period last year. Let's look at how cash is moving around. For the 6 months ended June 30, 2025, Ascend Wellness Holdings generated $23.7 million in cash from operating activities. This is a decrease from $36.1 million compared to $18.8 million in the same period of $20 million last year. Financing activities surprisingly used only $28,000 this period compared to $6 million last year. Financing activities surprisingly used only 288, surprisingly used only $28,000 this period compared to $6 million last year. Financing activities surprisingly used only $288,000 this period compared to $6 million last year. The company also provides adjusted gross profit and adjusted EBITDA figures, which are ways to look at their performance without certain non-time expenses. Their adjusted gross profit was $55.2 million for the 3 months ended June 30, 2025. An increase from $53 2025, an increase from $53 25, an increase from $53 million last year. Their adjusted EBITDA was $28.5 million, roughly the same as last year. This shows that while reported profits might be down, their underlying operational performance, adjusted for certain factors, has remained relatively stable. Now, a crucial aspect for any company, especially in the cannabis industry, is liquidity and their ability to fund operations. Ascend Wellness Holdings ended the period with $95.2 million in cash and cash equivalents. While they have an accumulated deficit and have reported losses, management believes they have alleviated to access capital markets for additional funding through debt and equity financings if needed. A major financial event was their 2024 notes offering, where they issued $235 million in senior secured notes. These notes carry a 12.75% interest rate and are due in 2029. This move was largely to prepay a significant portion of their existing credit facility. They followed this up with more term loans in early 2025, with additional borrowings in May increasing their debt, but also allowing them to pay off their old credit facility entirely. Looking beyond the numbers, the company's strategy seems to be focused on expansion through new dispensaries and partnerships. They are also committed to cost-saving initiatives and improving how they manage their working capital. They've added more partner stores and managed to increase their cash reserves. Let's break down their results. For the 3 months ended June 30, 2025, revenue dropped by 10%, mainly due to increased competition and price cuts in states like Illinois and New Jersey. Their wholesale revenue also took the hit. On the flip side, their gross margin improved thanks to better efficiency at some cultivation facilities and more of their own products being sold through their stores. General and administrative expenses decreased slightly thanks to cost-saving moves, but interest expenses went up significantly by 41% due to that new debt they took on. Looking at the first 6 months of the year, the story is similar. Revenue is down 10% compared to the previous year, again citing competition and pricing pressure. Cost of goods sold decreased, but their gross profit and gross margin also dipped. General and administrative expenses saw a notable drop of 14%, mainly due to lower compensation expenses and the absence of a large reserve recognized last year. However, like the quarterly results, interest expense jumped by 36%. It's important to remember that many of these figures rely on management estimates and judgments, which can impact reported numbers. They also mentioned that the IRS views cannabis businesses differently, leading to unique tax situations and potential liabilities. They have significant unrecognized tax benefits and potential liabilities related to tax positions, which could affect their future tax rate. The company's risk factors haven't changed much from their last annual report. The big ones remain the federal illegality of cannabis, the volatility of their stock price, and reliance on key personnel. They also face constraints in marketing and banking, as well as unfavorable tax treatment typical for cannabis businesses. Now, looking at Ascend Wellness Holdings broadly, they seem to be navigating a tough market with reduced revenue, but efforts to control costs and improve margins are showing some positive signs in their adjusted metrics. The significant increase in debt is a major consideration, and while they've managed to pay off their old credit facility, the new debt comes with a higher interest rate. Their expansion plans are ambitious and will heavily depend on their ability to secure further capital and navigate the complex and ever-changing regulatory landscape of the cannabis industry. The increased interest expense will definitely put pressure on their bottom line. Alright, that's our breakdown of Ascend Wellness Holdings' latest financial report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.